Did you know the chances of a recession in 2025 have doubled, now reaching 50%? Even worse, it might have already started. The problem is, official data usually takes around 7 months to confirm it. Many experts are already calling this the Trump recession. But what's really going on? And how does it affect your money, your investments, and your financial stability? Stick with me until the end of this video to find out how to protect yourself and even profit during a crisis. Don't forget to like, share, and subscribe. The real risk of a 2025 recession. According to updated projections from the Federal Reserve and Wall Street economists, the risk of a U.S. recession has reached 50%. That means the coin is already in the air. It could fall either way. This is especially alarming because there are real signs in the economy backing up this warning. Here's a worrying detail. Recessions are typically confirmed about 7.3 months after they begin. So we could already be in a recession without any official confirmation yet. That delay creates a dangerous gap of uncertainty, where people's perceptions can become more influential than the actual numbers. Contrary to popular belief, a recession isn't just 2 consecutive quarters of negative GDP. It's defined by a broad decline across several key economic indicators, like industrial production, employment, real income, retail sales, and private investment. When all of these areas start to weaken at the same time, it's a strong signal that we're already in a recession. If things are feeling more expensive, more uncertain, and just plain harder, it's not your imagination. It's a warning sign. And the sooner you understand what's happening, the better equipped you'll be to protect yourself and make smart choices. Likely causes behind the recession. Several factors are contributing to the scenario, but one of the most talked about is the return of aggressive trade policies by former President Donald Trump, who has already stated that, if reelected, he'll impose import tariffs of up to 60% on countries like China. While the political move, it has very real economic consequences. These tariffs don't just affect imported goods. They trigger a ripple effect. Companies that rely on foreign materials face rising costs, leading to lower investment, layoffs, and production slowdowns. That hits business confidence hard and slows growth across the board. On top of that, consumer and investor confidence takes a hit. And without confidence, people stop spending. Without spending, there's no growth. Consumers delay purchases, businesses halt expansion plans, and capital freezes. Now combine that with government stance that, for political reasons, is willing to accept a temporary economic slowdown as a necessary price for broader commercial or geopolitical goals. The result? A deliberate slowdown with very real consequences for you, your income, and your wallet. It's seen as an acceptable side effect, but in practice, it affects millions. Expected economic impacts. If the recession is confirmed or is already happening, its impacts will be significant. We're already seeing early signs in consumer behavior and company earnings reports. But the most intense effects usually come in waves, so being prepared is key. Stock market. Historically, recessions bring average drops of up to 30% in major indexes. Volatility skyrockets, and fear takes over. Investors often panic sell at the worst possible time. Unemployment rises quickly. Every 1% increase can mean millions losing their jobs. And the longer someone remains unemployed, the more it erodes their household's financial base. Wages. With more people competing for fewer jobs, wages fall by an average of 7% during prolonged downturns. This weakens consumer spending and fuels a negative cycle. Private investment shrinks. Companies pause expansion plans. Projects get shelved. The fear of making the wrong move freezes capital. And the economy feels it right away. Investor behavior. There's a flight to safety. Money flows out of stocks and into cash, gold, government bonds, or money market funds. A mindset of scarcity and protection takes over. And without a clear strategy, it's easy to get lost in the chaos. How markets behave during recessions. But here's the thing. A recession doesn't automatically mean the stock market will crash. That's a costly myth for anyone who acts on impulse. History shows that financial markets tend to react early and often in unexpected ways. Yes, on average, markets do fall during recessions, but market behavior is more complex. In several past downturns, The market actually rose even while the GDP was still declining. That's because markets often price in the recovery long before it appears in official data. Example, after the 2001 recession, the SEP 500 showed positive returns in less than 12 months. And this pattern repeats itself. In 85% of cases, the market bounces back within a year following the recession's end. In 100% of cases, recovery happened within 3 years. The problem is, those who panic and sell too early miss the upside when it starts. The key? Investors who stay calm, keep investing, and take a long-term view tend to reap the biggest rewards later. Those who bail out at the wrong time often pay the price for acting too soon. Real estate during a crisis. While financial markets can be volatile, real estate has shown resilience in past recessions. And that's no coincidence. It's a result of solid fundamentals and emotional behavior of consumers. Why is that? Falling interest rates often lead to more accessible financing and boost home purchases. With cheaper credit, many take the opportunity to buy property under better conditions. Roughly 40% of U.S. homeowners have no mortgage. That means they're not under pressure to sell quickly, which keeps distressed sales low and helps maintain price stability. Limited supply and steady demand. People still need places to live, even during tough times. Rental demand typically increases, which supports the market overall. On the flip side, we may see more properties hitting the market from investors, house flippers, and short-term rental owners, like Airbnb hosts, who might pull back in a slowing economy. This shift could put pressure on prices in specific areas. Still, rents tend to rise since more people will be unable to qualify for mortgages and will have to rent instead. In other words, even in a downturn, real estate remains a relatively safe haven. Tariffs as a bargaining strategy. Import tariffs have been used as tools for pressure and negotiation, creating a familiar cycle that seasoned investors recognize. The government threatens new tariffs. Markets react with dip. A truce, rollback, or retaliation follows. Markets rebound positively. This has been a common tactic used by Trump to renegotiate deals and pressure countries, recently seen in the case of Israel, which had to revise trade policies to avoid sanctions. It's a high-stakes chess game, with businesses and consumers as the pawns. The problem? Moves like this create ongoing instability in the markets, which disrupts business planning and shakes investor confidence. Chronic uncertainty becomes a norm, and capital doesn't like uncertainty. Investment strategies in a recession. Here's the most important part. How should you act in this environment? It is possible to get through a recession safely and even profit. If you know what you're doing, keep investing. Historically, recessions are the best times to buy quality assets at a discount. Warren Buffett famously said, "Be greedy when others are fearful." And he's right. Think long-term. Markets reward patience. If you cash out during a downturn, you lock in your losses. If you hold on, you recover. Don't turn a temporary loss into a permanent one. Focus on income stability. In turbulent times, your top priority should be protecting your main income source, whether it's your job, your business, or freelance work. Without that, everything else falls apart. Diversify. Build a balanced portfolio with stocks, funds, an emergency reserve, and protective assets like gold and inflation-linked bonds. Diversification is your financial life jacket. Prepare for extreme volatility. Markets swing harder during crises than they do historically. That's normal, but it requires emotional control and a clear plan. Have one and stick to it. Avoid impulsive decisions. This isn't a game of short-term wins. You're building long-term financial freedom, and that takes discipline, not panic. Yes, the risk of a recession is high. It may have already started. But as we've seen, economic crises also bring opportunities for those who are ready. If you act calmly, with strategy and long-term vision, you'll come out stronger than before. Protect yourself, but don't freeze. Keep learning, keep investing, and keep managing your money wisely. If this content helped you, give it a like, leave your thoughts in the comments, and share it with someone who needs to better understand what's going on right now. And of course, subscribe to the channel so you don't miss the next videos with practical tips on finance, investing, and a success-oriented mindset.